Hello, good evening, and welcome. Thank you so much for tuning in. Whether you are tuning in live or watching this on a recording later, I really appreciate you coming out. My name is Erica Belay, and I am a mortgage loan officer for Best Life Mortgage Corporation. Best Life Mortgage is a brokerage. So what that means is that I, as a mortgage loan officer, I work for my client, not for lenders. We have access to about 20 or so different lenders. So when I work with a client, I basically shop through all of my different lenders to figure out what the best loan program is to meet my client's needs. Just a little bit about me. I was born and raised in New Braunfels, Texas, grew up in Texas. I currently live in Kyle, but I can do loans anywhere in the great state of Texas. The presentation tonight is for first-time home buyers. It's just kind of a little bit of a mortgage overview. But really everything I'm talking about is good across the country. But for me personally, I'm only licensed in the state of Texas right now. So welcome so much. Thank you so much for coming. I'm going to get started here. Let me see. Let me change my screen so you can see my presentation. So what I'm going to cover tonight is just a little bit about what is a mortgage. What does that even mean? What is the loan process? How is your loan officer paid? And what is the role of your loan officer? And really about just some of the different types of loan programs. I know that especially first-time home buyers, but really just the general population, there are so many different loan programs out there. And I'm confident that I could find the right loan program to meet my clients' needs. But just to have a little bit of an understanding of what you're eligible for and what you qualify for, if you're sitting there thinking, I could never qualify for a loan, maybe you can. So I'd love to be able to help you. So the first question, what is a mortgage? A mortgage is basically an agreement between a home buyer or homeowner and a lender. This is an agreement that would allow you as the home buyer or the homeowner to borrow money from the lender for the purpose of either purchasing or refinancing real estate property. But this agreement also allows the lender the right to take the property if there's an extended failure of repayment. So what makes up the monthly payment of the mortgage and when is it paid? Your monthly mortgage is usually made up of your principal. That's the original loan amount that you borrowed. The interest, so the interest rate that is accruing on the loan. Then your property taxes and your insurance. Now your insurance could be your homeowner's insurance as well as if you're having to pay mortgage insurance. So this term is typically called PITI, principal, interest, taxes, and insurance. So as a first-time home buyer, you might hear that term thrown around a lot, PITI. So that's principal, interest, taxes, and insurance. This also would include if you are living or purchasing in a community that has a homeowners association, your homeowners association dues would also be part of your PITI. The first mortgage payment is due the one full month after the last day of the month in which your home purchase closed. So for instance, if you buy and close on a house in January, your first loan payment would not be due until March. So you typically do not have to make that first payment in the first month. So a lot of times people will close at the end of the month and they wouldn't have to make their payment right away the next month. It wouldn't be paid till the following month. Okay, so let's just talk a little bit about the common steps from beginning to end in the home loan process. So there are typically about 7 main steps, and then there's a whole bunch of small steps along the way that are happening behind the scenes. But for first-time home buyers, the first step is submitting a loan application. So you're going to submit your loan application, and that's when the loan officer will pull your credit. And so the step 2 would be really the loan officer will do the research. They'll get information about your situation, figure out what your income is, what your debts are, what your credit score is, and search through different lenders. And for me as a broker, I have access to different lenders. If you're going through a bank, you don't have as many different options to shop through. But basically, the mortgage loan officer is going to find the best loan and get you that pre-approval. So once you are pre-approved for the loan, then you can start shopping. That's the fun stuff, right? Nobody really wants a mortgage. You really want the house, right? So unless you have a bunch of cash to buy a house, the mortgage is a means to an end, right? So once you go and find your home, you put in an offer, your offer gets accepted, then a sales contract is submitted to me. Or to your loan officer. So at that point, that's when we submit your loan to underwriting. And so you've had a pre-approval, you've got your contract, we submit the loan to underwriting. The underwriters are going to look at your situation, and then you're going to come step 4 is getting the conditional approval from underwriting. So usually they say it's approved with conditions. That means they're going to request a few more things, some different documentation. So once you're in underwriting, then the loan file is submitted to processing. This is where you are required to get your homeowner's insurance. So if this is a new purchase, you have to get homeowner's insurance for that home. There's going to be title work. There's typically an appraisal ordered. In some cases, you can get an appraisal waiver, but an appraisal is ordered. So during this time as a home buyer, you're really just waiting, and you're coming up with any of the documents that the underwriting has requested. And so once all of the information is submitted, including the homeowner's insurance, all the title work, the appraisal, and any of the other conditions, then that's when we might talk about locking your interest rate. Sometimes you might lock your interest rate before this point. Locking your interest rate, interest rates are kind of always a gamble. They go up and down. Rates change multiple times a day. So even when you get that pre-approval at a certain interest rate, unless you've locked that interest rate, that rate could change until the time that you finally decide to lock it. And so I'm not going to go into a lot of information about interest rates today, but locking your interest rate is a conversation that you need to have with your loan officer to determine, is that interest rate going to work for you? Is the payment at that interest rate going to work? And then deciding if it's time to lock or not. So once you've locked that interest rate, once all of your conditions are submitted, underwriting is approved, we get the final approval. So we call that CTC, clear to close, which is always a celebration when you're clear to close. And you schedule that closing, and you get the keys to your new home. So those are the basic 7 steps to the home loan process. So one question that we get asked a lot is, how is the loan officer paid? It's a fairly common question. And so it could be different in different places, but when a loan officer works for a brokerage like I do, there are 2 common ways that the loan officer gets paid. And that is either lender paid or borrower paid. So essentially, when the mortgage is structured as lender paid, what you as the borrower need to know is that the lender is going to pay the mortgage loan officer any of the fees, but the lender makes up for these fees typically with a slightly higher interest rate. And so basically, the mortgage loan officer's fees are built into the price of the loan, built into that interest rate. So that is lender paid. And the benefit to this is that it's not as much money out of pocket for the borrower up front. Now, if the loan is structured as borrower paid, that basically means that the borrower is going to pay for the loan officer and the brokerage fees. And so you'll probably have a little bit lower of an interest rate if you structure it as borrower paid, but you'll have to cover the loan officer and brokerage fees at closing. These are known as origination fees. And so they're part of your closing costs. So that's a conversation that you can have with your loan officer. I'll tell you, for me personally, I typically structure the loans originally as lender paid, but it's a conversation that I have with my clients if we want to switch it to borrower paid, depending on the client's situation. So these are things to know about and discuss with your loan officer. So what exactly are you paying for? You know, what does the loan officer do? And so, you know, there's first and foremost, you know, the role of the loan officer, such as myself, is to help you achieve your homeownership goals. So what does that look like, and how should a loan officer serve you as a home buyer or homeowner? This is more easily answered by going over what you do as a borrower. Go over what you do as a borrower of the home loan. You, as a home buyer, will need to complete a home loan application, decide what loan program fits your needs, along with deciding what homeowners insurance, title company, realtor. Those are all decisions that the buyer has to make. However, the loan officer is there to help you and coach you and make this process as easy as possible for you. There's a lot of things behind the scenes that the loan officer does. And basically, it's putting a big complicated situation together like a puzzle. You know, we're going to ask you a bunch of questions about your income, about your finances, about your credit score, about your lifestyle, about what kind of payments you feel comfortable with. And then we're going to try to help structure a loan that's going to best meet your needs, while also helping you understand all of the different steps along the way. You know, there's a little bit of a stigma that it requires a lot of paperwork, and it does. I mean, you as a home buyer are getting lent quite a bit of money. So lenders are going to try to verify that you are a worthy borrower. So that requires that you produce documents, that you produce proof of employment, that you produce proof of assets. You know, if you have money sitting in a fire safe box that you want to use as a down payment, well, that doesn't work. We have to have assets, have to be seasoned, they have to be in the bank, they have to be sourced. And so the loan officer is going to help you through all of these complicated things, while also making sure that we're meeting all the loan program's requirements. Every different loan program has different requirements, different rules, different things. And so that's one of the things the loan officer does, is familiarize themselves, and especially with different lenders, with what the different lenders overlays and the different lenders requirements are. And then also listening, like I said before, to the buyer's needs, to your goals. We just want to make this as stress-free as possible, but also make sure that we are being compliant with all of the guidelines. So what are some of the different programs that are available? I mean, I'm going to talk mostly about first-time home buyers here, but really there are so many different loan programs available for all borrowers. So let's talk about the most common, which is the conventional loan. So there are a lot of different conventional loan programs. There are conforming and non-conforming conventional loans. So there's a bunch of different types of conventional loans that could potentially meet the needs of the client. Basically, what a conventional loan means, though, is that it can be sold on the secondary market, and the guidelines are created by Fannie Mae, Freddie Mac. You might have heard this. I'm not going to get into a lot of detail about that, but this is by far the most common loan program out there. It's typically got some of your better interest rates, but there's going to be some strict requirements. Now, if you are a first-time home buyer, what does a first-time home buyer mean? That means that you have not purchased a home in 3 years. So even if you owned a home a while back and you sold it, if you have not owned a home for 3 years, you can be considered a first-time home buyer. So one of the perks of a conventional loan is, for a first-time home buyer, you can do as little as 3% down payment. Typically, if you're not a first-time home buyer, the minimum down payment for a conventional loan is 5%. And a large down payment can truly be one of the biggest barriers for first-time home buyers if you don't have a whole lot of assets saved for that down payment and those closing costs. So for the first-time home buyer programs for conventional loans, it's a down payment as low as 3%. You do need to keep in mind that 3% is the down payment, but you also have to consider closing costs. And so there are different requirements for that, but typically a conventional loan is going to have some strict requirements for credit score, credit history, income, employment. Now, in addition to conventional loans, there are government loans. The government loans are FHA, VA, and USDA. They have a lot of similar requirements with these. The difference is just that they are backed by the government insures these. And so that really all that means is that if the client or the homeowner goes into default, then the government backs up some of this so that to save the lender, basically. So let's talk a little bit about FHA. FHA is probably one of the most common loan programs for a first-time home buyer. It is a 3.5% down payment. FHA is typically a little bit more lenient on credit history and credit score requirements. So if you cannot qualify for a conventional loan with your credit score or your credit history, then there's a chance you might be able to qualify for FHA. FHA is a great loan to help a first-time home buyer get into a home sooner rather than later. I always believe that it is better to purchase a home and invest in an asset that is going to build your wealth rather than rent, which is basically building somebody else's wealth and kind of throwing money down the drain. So FHA is a great program to get you into a home. It does have higher mortgage insurance typically than a conventional loan. Now, if you only put 3% down on a conventional loan, you're also going to pay mortgage insurance. So the only way to avoid mortgage insurance is to put 20% down. I do have one lender who does not do mortgage insurance if you put as much as 10% down. But you are going to be paying mortgage insurance typically if you don't put 20% down. With an FHA loan, that mortgage insurance is a little bit higher, and you are stuck in that mortgage insurance for the life of the loan. With a conventional loan, the mortgage insurance goes away once you have 20% equity in the house. So that might be going a little bit too deep, but really, typically what I suggest to my home buyers, if they're using an FHA loan, is that as soon as we can, we're going to refinance you out of that FHA loan into a conventional. So that might take 6 months, that might take a year, but we want to refinance the home into conventional to get you out of that higher priced mortgage insurance. Now, in addition to FHA, we've got VA, which is our other government loan program. Obviously, this is a loan program for veterans. This can be for first-time home buyers, but you don't have to be a first-time home buyer to qualify for a VA loan. It is one of the best loan programs out there, and one of the best things about a VA loan is that it is 0% down payment and no mortgage insurance. What a great way to thank a veteran to help you achieve the dream of home ownership. And thank you for your service by giving you some of these perks of not having to come up with the down payment, not having to pay that mortgage insurance. You do typically still have to pay closing costs for a VA home loan unless you can get seller to cover closing costs. And there's some different things there. So no matter what loan you do, you will have closing costs. So another 0% down payment program is USDA. Now, USDA is also considered a government loan, and it has 0% down payment. It can be used by first-time home buyers and home buyers who are not first-time buyers. But this program is designed for a rural area, meaning with populations no larger than 30,000. So if you live in a city or you live in the suburbs with a population of higher than 30,000, USDA is probably not going to be an option. But if you do live in a rural location, then USDA is absolutely an option. And it's a great option if you don't have a lot of money for your down payment. Now, there are also income limits for the USDA program. And so there's a way that we calculate that. And there's actually a website that we check. We look at your income and see if your income meets those requirements. But USDA does have strict credit requirements and does have income limits. So again, as your loan officer, we would check to see, is this the best program for you? Do you qualify? Do you meet those income and credit requirements? And if you do, it is an absolutely great program. Now, those are the most common: conventional, FHA, VA, USDA. Okay. And I would say, conventional and FHA are probably the two most common for first-time home buyers. But in addition to that, there are a whole bunch of other specialty loan programs out there to meet the needs if you don't qualify for a conventional loan or an FHA loan or a VA loan. So some of these specialty loan programs include down payment assistance. So there are down payment assistance programs that can be used with FHA or with conventional. But we also have some other specialty programs that such as a bank statement loan. So when you, if you are a self-employed borrower and you write off a whole bunch on your taxes, and so the income that's reported on your taxes is not really reflective of what you actually make because of all of your write-offs, maybe you don't qualify for the home at the price point you want. Well, we have a bank statement loan that basically just looks at the deposits that you put into your bank account and determines your income from the deposits on your bank account without looking at your tax returns. So that's a really cool program, especially for self-employed borrowers who are writing a whole lot off on your taxes. So we've got that for business owners. Same thing if you are a contract worker, 1099 worker, we've got a 1099 loan program. It just looks at your 1099s and doesn't necessarily look at your tax returns and all of your write-offs. Okay. So there are a bunch of different programs out there. So if you're at all curious and you're a first-time home buyer, even if you're not a first-time home buyer, if you're at all curious about whether you can qualify for one of these loans, reach out to me, reach out to a loan officer, and we can figure out if you qualify, right? Some of the other specialty products that I have are not necessarily for first-time home buyers, but if you are a real estate investor, you want to buy rental properties, it's called a debt service coverage loan, where if you have money for a down payment, we would do a rental appraisal on that home. And if the rental appraisal comes in higher than the PITI that we talked about earlier, comes in higher than the mortgage, then you qualify. So as long as you have good credit and a down payment, we wouldn't have to look at your income documentations because it would be based on the rental income that property would produce. So there's all kinds of different specialty loan programs out there that can meet the needs of the borrowers or the investors. Typically, and I almost forgot to say this, typically with some of these specialty loan programs, these are coming more from private investors. They're not purchased on the secondary market by Fannie and Freddie. So with the specialty loan programs, such as the bank statement loans, the debt service coverage loans, they are typically going to come with a higher interest rate. But it is still a means to get you into a loan. And then again, a lot of times, anytime I get a borrower into one of these specialty programs, if down the road they qualify for a conventional loan, we always want to look into refinancing down the road for a conventional loan if that has a better interest rate or has better terms to meet your needs. So basically that pretty much covers everything that I wanted to talk about tonight. Again, I want to talk about Best Life Mortgage, my company. We are a brokerage. So I have access to 20 different lenders, give or take. And so I can shop through all of these different lenders for you to figure out the best loan programs. I have almost all of my lenders do conventional loans. I have several lenders that do these specialty loans. So I can figure out which lender is going to give you the best rates, which one's going to give you the best terms, which one's going to have the guidelines that fit with your needs. But just a little bit more about my company, Best Life Mortgage. It is our mission to help people achieve their best life, one mortgage at a time. And we accomplish this by giving our clients a first-class customer experience. We want you to be our clients for life. And we want you to refer your friends and family to us. We empower all of our team to embody a growth mindset. I will say that since I've joined Best Life Mortgage, this has been a huge growth for me personally, spiritually, physically, mentally. I've been on this kind of growth journey since I've joined this company. And so I want that for my clients. But one of the things that I am absolutely most proud of about Best Life Mortgage is that we are a tithing company. We give 10% of our corporate profits to make the world a better place. Every loan that we close helps liberate kids from the bondage of human trafficking. We donate our money to a company called Destiny Rescue that does a lot of, they do some rescue operations where they go undercover and rescue children from human trafficking situations, and then provide counseling, provide therapy, provide training to help these children who are victims of this live and create their best life after such horrible things. So very, very proud of this mission of our company, and would love to serve you and help you get a home loan. So thank you so much for coming to this training. If you have any questions or want to see if you qualify, I can do a no obligation analysis to see if what you qualify for and get you pre-approved. So my cell phone number is 210-279-4392, or you can email me at ericabelay@bestlifemortgage.com, or you can send me a direct message or put a comment on this. I think this is streaming on Facebook, LinkedIn, and YouTube. So whichever platform you're watching this from, you can make a comment. So thank you so much. Happy New Year. Hope everybody has a great 2022. I'd love to help you meet your goal of homeownership. Have a good one.